Hardware is not the only reason EV charging sites fail. Some sites struggle because the economics behind them were wrong from the start. In this episode of Field Frequency, I'm joined by Rohan Puri, co-founder and CEO of Stable, a company that helps operators figure out where chargers actually can make money. We talk about why most chargers underperform, why dynamic pricing is inevitable, and why some sites should be shut down entirely. We also talk about why private equity is quietly moving in while others are pulling back. This is a grounded conversation about EV charging as a viable business. Let's talk about it. Welcome to another episode of Field Frequency. Today I'm joined by Rohan Puri. Very glad to have you on, Rohan. Wanted to get you on for a little bit of time and glad we were able to finally align schedules and get this booked, and happy to have you on Field Frequency.
Thank you so much for having me, Jason. Appreciate it.
Yeah, well, it's a lot of excitement watching the progress of Stable, watching your journey in the mobility space. But for the audience, I'd like to just kick things off with your background before Stable, before EV infrastructure analytics. Just take us back. Give us your origin story and the vision that led to Stable.
Yeah, absolutely. So, we actually started out, it was my co-founder and I. My co-founder is Jamie Shiel. We both met in Boston at MIT's Media Lab. We used to work in a group there that built all sorts of different sensing technologies and everything from cameras to biometric sensors, et cetera. And we did a lot of math on that sensor signal.
Okay.
That helped us build, the competencies that we eventually used at Stable. And so we're both very technical. There's a research group there that we worked at for a number of years. We spent a lot of late nights together. At the time, we were starting to see the first emergence of self-driving electric cars coming out, and, Cruise was launching and Waymo was the thing, and there was Zoox and all sorts of things were happening. And actually the way that we originally started Stable was those companies that did a lot of work with our research lab, and same with OEMs. And one of the questions they had was, hey, we're about to deploy these massive self-driving electric fleets, but we actually don't know how we're going to charge them when there's no driver behind the wheel. And charging is going to be a big part of how they operate and their operating behavior, because we're going to do small top-offs throughout the day to keep them on the road, keep the vehicle utilization as high as possible. So we need a way to charge the cars and to do a number of other tasks. So Stable actually started as a robotic charging and services company. We took these off-the-shelf robotic arms that were built to plug those cars in and do some basic tasks around calibrating cameras and stuff like that, and deployed the world's first robotically operated charging facility alongside Electrify America. And that was built in the Mission in San Francisco. We had a big office, warehouse space there. It was a wonderful space. But we deployed that office, or that facility, in February of 2020, which is absolutely probably the worst possible time to deploy anything with physical goods.
Wow, what was going on? Was something going on then? Was that not a good time?
Just a little old, global pandemic, and with which, SF was one of the first cities in the US to close down. And, obviously, like, the self-driving fleets couldn't get into their drivers in their vehicles. They couldn't get riders in their vehicles. The rideshare companies had much bigger problems. The ridership was plummeting. We couldn't get to the office. But thankfully, in that whole process of getting these fast chargers installed with Electrify America, we were trying to be very strategic about where did we put that charger so that these fleets could use them. And so maybe even next sites, the public can also use those sites to drive utilization as high as possible. And in that time, we sort of tried to understand, where is the optimal location for these chargers, and how do we want to run them so that they're running, one charger is charging as many vehicles as possible. So that's what sort of started Stable. After a pivot there in 2021 timeframe, we launched the Stable that we have today, which is a software company to help place and operate your chargers to get to your IRR as quickly as possible. It turned out that was just a much bigger need, much more important need around that, right? It didn't matter if it was a robotic charger. It just mattered, I have hardware to deploy, and it's very expensive. I need to know where I should deploy it and how I should operate it so it pays back for itself as quickly as possible.
I know it's part of the origin story. I've got a tangential question, just got to ask it. Yeah. Robotic arms charging the vehicles. I know that this is not where we're going to go in this conversation, but for those that are listening, they probably want to know, how does that open the car? How does it open the front door of the lid where the plug inlets are? How does that work? How's that work?
Yeah, so we actually there's a couple different ways. It turns out different cars do different things, which made it a big pain to do. But Tesla, you can actually just send a radio signal and it just pops open automatically. A lot of the self-driving fleets only use like one or two makes and models of cars. So we had like the Chrysler Pacifica was one that was being used by Waymo quite a bit, and the Chevy Bolt was being used by GM Cruise. And with those, you can just push the lid, it pops open, and you swing it open, and you plug it in. There's not much more to do. So you had a robot arm that would just push the lid at the right spot, swing it open, plug it in.
Well, that's again tangential question, but just for those listening, I'm curious how that worked because we know what's involved in the interconnection. Well, all right, so got the story on what the catalyst was and what kind of the roadmap was to developing what Stable's core product is. So I want to talk about product strategy, and I think also as you're leaning into that, as we talk about what that means, maybe kick off with where Stable sits in the EV/EV charging infrastructure value chain. For those that don't understand, some may, we'll probably be talking about software. They're going to think, well, maybe they're a CPO. Well, you're not a CPO, so maybe tell where Stable sits in the EV value chain, and then let's get into product strategy. I got a question about kind of some things related to the product.
Yeah, absolutely. So we're not a CPO. We don't own and operate, in our own charging network or anything like that. We provide software tools that CPOs and asset managers use to turn a profit as quickly as possible on that infrastructure. And so we think the two keys to it, we treat EV charging as like a commodity, right? And so what is going to differentiate one set of fast chargers from another set of fast chargers? Well, it's probably not, purely things like the brand and the software experience on the chargers, although those matter, right? It's probably not the most important thing. The most important thing for fast chargers, turns out, is, you put them in places that are convenient for most people or certain classes like rideshare drivers. And then you price and operate those chargers at the best possible margin, right? You try to maximize dollars in, energy cost minimize, maintenance minimize, the set of operating tasks. So we provide software that sits on top of that. Doesn't matter what hardware you're using, doesn't matter what software you're using on the chargers, you can still use our tools. And the core of everything that we do at Stable is we attempt to predict what the utilization of a charger will be. So one tool we have called Stable Evaluate attempts to predict what the utilization of a new site will be, right, a net new location. We give you some ranges and expectations based on a machine learning model, et cetera, et cetera. Our Stable Operate platform takes assets that you already have in the ground that are already doing stuff, and it tries to predict utilization next week, next month, next quarter, right? And the purpose of that is if for site selection, of course, like a higher utilization site, probably want to choose that over it, especially if the energy costs are likely to be low on that utility territory. But if you have a site that's already in the ground and I'm predicting that utilization is going to go down a ton next week because it's some holiday and nobody's driving that holiday, then you might make some decisions around your energy caps, your pricing for the site, but it all comes down to how well can you predict demand. And if you think about it, for other sort of high volume, low margin commodities out there, like in airlines and energy and hotels and all these things, it's the same game. You're trying to predict what demand's going to be over the Christmas holiday and price your airline tickets accordingly and optimize how many flights you're going to go. And that's the entire game of building those few cents of margin on top of it. So that's where we sort of sit, is we help make those business decisions. Where do you place it? How do you price it? How do you operate it? So that when you're going into your back end of your charging stack, you know what to do.
These solutions that you've brought to market, man, they needed to have been here early on. I mean, just the way you've outlined what Stable Evaluate does, what Stable Operate does early on. And when I'm saying early on, pre-2020, there was put the chargers in where we can get them in. That was kind of the mindset. Put them in where we think they go. Put them in where it's easiest or quickest pathway, least resistance in terms of infrastructure that's existing, installation that's needed, et cetera. And so that created some faulty programs early on because, again, what you've brought to market is a solution that says focus on ROI, and ROI is going to be driven by, are these chargers where they need to be? If not, don't put them there, put them here. So siting tools. And then, of course, the optimization through Stable Operate. And so that's those are game changers. And you talked about ROI in your initial opening statement. Whenever I started asking about product, you started talking about profitability. Those are things that we need to be in to get to that industry maturation we're so desperately in pursuit of, but we've been so far away from, because the idea of a profitable charging destination, I can't tell you how many different CPOs have talked about, to be profitable at this site, I'd need to sell at, $2 a kilowatt.
Right.
to be not just just to be profitable, not even to
Mhm.
break to be profitable. So, utilization nuance, that's clearly a part of the goals and part of the solutions that you're bringing to the CPOs. It would
Right.
seem like CPOs would be clamoring for your solution. Your data suggests that a majority of usage is concentrated in a minority of sites. Wrong place. Wrong place. Are there
Right.
simple heuristics that you've learned through working with your customers about what separates a high utilization charger from a utilization one? In other words, where's don't want you to give away the secret sauce, but just fly over. How do you help the customer begin to understand that?
Yeah, I mean, we try to predict and forecast it, right? And of course, we're wrong sometimes, but most of the time we're pretty close. And so the problem with a prediction is that it doesn't always line up to what your intuition says.
Okay.
So you think like intuitively, this is a mall. I know this area is a
Mm,
popular place. Let's put a charger there, and we might say we don't think it's going to be that well utilized, and you might ask why. And what it comes down to is that it's not just a function of like how popular is the area. You have to look at a bunch of things, right? Like how many EVs are in the area, how many of those EVs are likely to drive by that area? And then are they going to drive by when they actually have depleted battery? Or are
mm,
they driving like 5 miles a day on average? Like they
mhm,
charge at home most of the time.
mhm,
So just because you got a lot of EVs and a lot of traffic doesn't mean it's a good site for a charger, especially if there's things like competition nearby
mhm.
and you can charge at home and or the prices are crazy. There's just so much to consider there when you try to understand like if this is a good site. I'll tell you what some common traps are. People tend to over focus on, I mean, you're totally right. Like people started to deploy chargers where it was easiest. And then we had a generation of chargers deployed where the rebates were.
Mhm, mm,
Right. Wherever we're going to get dollars in, that's where we're going to deploy. And there were networks whose entire strategy was just around rebates, right?
mhm.
Which is fine, right? It has its own paradigm. You don't care as much about utilization in those cases. Neither is trying to look at long term fundamentals. At some point, the charge has got to be utilized enough, or you're going to end up shutting it down at some point, right? The maintenance won't be worth it. So that's why I focus so much on fundamental utilization. Here's one common trap I see, which is this like fear of competition. So
Okay.
Tesla has a site across the street, or EVgo, or like Try America is going to deploy there, or whoever, name your CPO. Let's not deploy there. Now, from one perspective, that's reasonable in the sense that maybe they took all the capacity and the transformer upgrade's gonna be crazy for you. But on the other hand, we actually find that when charging locations that pool together, everyone benefits from better utilization than they otherwise would have had most of the time. So what we tend to see is that, you deploy and then your competitor gets better utilization and you get better utilization because there's just more options and drivers say, I have many alternatives. I'm not going to be waiting. We don't know for sure why, but we see that effect and we've had to model that effect.
Mhm,
And so that's not intuitive, right? People think of like gas stations
mhm,
competing for fixed demand.
mhm.
But the problem with EVs, for example, is that it's not fixed demand. Like the EV market is growing. So it's not like there's a fixed number of EVs that you can charge every day. It's a fixed and growing number of EVs that you can charge every day. And the way that consumers pick sites now, there aren't that many. So you're kind of just picking the most convenient, closest one, and sometimes you're desperate and you'll go anywhere, right? For any price. And it's a very different dynamic than how people think about gas.
Yeah, that's so many good analogies came to mind as you were explaining that so well. Obviously, the gas station model is what we know because we're conditioned to 100 plus years of retail fueling and the gas station experience. But you mentioned the site. Well, I not put here because across the street is brand X. What do I do? And so it's not it's very interesting, and the solution that you're working through and the education that you're bringing through data, I think is really imperative because, like you said, with the example of the mall, well, there's lots of traffic, lots of visibility, lots of activity. Yeah, but maybe no one's going to charge there because they're passing through or they're charging at
Yeah,
home because all of that. And so it's almost like you could be a contrarian to one that's all positive about a site, but then you could be really positive and say, no, you need to deploy here because, and data is
right,
supporting all of that. So it's not just gut. That's not what
right,
it's about. In the gas station model, you got Exxon over here, and across the street, you got Shell. And it could be that upstream ownership owns both of those pieces of property and they
yeah,
just have different oil contracts. But
mhm,
they're still competing. They're still competing with customers and experience, amenities. When I talk about experience, the experience that the guest has there is all of that is competing for the amenities. And so it's an opportunity for the CPO that, hey, you have through data, provable data points that would support you having a successful charging deployment here. If you want
mhm,
to differentiate yourself, amenities,
yep.
canopy, et cetera. Yeah, so that's
Right.
I appreciate you kind of laying out these ROI realities and these charging economics, and even the misconceptions that are around that. I think it's good that you double clicked on that. Maybe this is in the vein of operate, the feature of dynamic pricing. I'm assuming that's
Mhm.
probably a value proposition within stable
For the
operate dynamic pricing. So how rare is dynamic pricing in public charging?
Yeah. It actually turns out almost everybody is now, all the major networks have started at least some degree of dynamic pricing. And when I say dynamic pricing, people tend to think it's like minute to minute, second to second prices. That's not the case,
Mm,
by and large.
mhm,
But for example, Tesla's already rolled this out in Europe, in California. EVgo has it on almost all their chargers. You can see their prices change, right?
mhm,
Not every Wednesday are you going to see the same exact price on Wednesdays at 2 p.m.
mhm,
And Electrify America has done it as well. Like there's been now it's evolved from like little pilots and experiments to
mhm,
like, oh, we're doing this. And they've been public. They've been on record about it. So we're seeing it more and more. And it's fundamental. Like you have to do that. Like the price from the utility is dynamic, right?
mhm,
You
mhm,
might say, oh no, it's fixed. It's not. It's a demand charge dependent. So if I had a bunch of Porsche Taycans charged at the same time at my site on the first day of my billing period, and I'm going to have to pay this massive, demand charge for that month, you damn straight I'm going to change my pricing strategy going forward, right? Like
yeah,
I should, all
yeah,
right? I have to do something about this, and
yeah,
otherwise I'm going to lose money. So if the utility can do it when demand spikes, so can you. And likewise, if the utility tries to incentivize you using energy when demand is low, then so can you. And the question is like, how much does that drive back and forth? So it's a natural extension of what needs to happen here, and you have to balance it with the driver's expectations. Because nobody wants to like know it, think it's one price, and then it shows up and it's a different price. But you can get around that just like you get around with everything, right? Like Uber, you expect the price is going to change if you check it 5 minutes later,
mhm,
right? So
mhm.
that we're used to it. We're used to it in airlines. We're used to it with hotels, with concert tickets, everything. It works that way when it's like this type of thing.
Well, there's even parity in the retail gas world with that
Hmm.
because okay, so when the tanker leaves the refinery with that fuel in its tanker and it arrives at the gas station and drops it in that tank, obviously they've procured that fuel, whether they were the
Right,
refinery themselves and they're selling their own fuel or they bought it. They
right.
drop it in those tanks and then the price goes up on the price sign. Well, the fuel that was in that original drop may not be depleted before the price on that sign
Oh,
goes
for sure.
up or goes
Yeah.
down. Either way, because it's market influence. And so the idea of dynamic pricing to those that are in the EV space, it just makes sense. It makes sense to the
Mhm.
operator. For those that are on the outside looking in that maybe don't drive an EV or don't understand the dynamics of the technology that drives this, it could be like a barrier. It's not a barrier. It's actually helping them be competitive, like you said, with the example of multiple Taycans charging in the early part of the month, demand charges. Well, now your bill is astronomical, which could have been offset by a proper pricing strategy. When it comes to dynamic pricing, are there any like for those listening, they may have this question. Are there technology barriers? Is there some operational process that affects that makes that easy, not easy to do? Maybe that's the perspective of the CPO. Maybe they don't understand how does that work?
Yeah, there are definitely barriers. A lot of it tends to be, getting the prices to propagate throughout everything. So you see, you set a price. Typically what we're seeing is like the happy compromise of dynamic pricing. We tend to see is we let our customers, they decide what they want, they decide their prices, everything. But the 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 frequency is typically like once a week maximum. You might update your pricing for the week ahead.
Hmm.
More than that, like, honestly, our systems can't really handle it yet. You want, like, the app to show the same thing. You want the
Hmm.
credit card reader to bill the same thing.
Hmm.
You want all the, plug share and Google Maps and all those things to all say the same thing. And so that's one of the challenges. In Europe, there's a even bigger challenge, which is all these EMSPs in the middle who are sort of like they charge their own fee on top of the fee from the CPO. So those tend to be like the bigger challenges and just
Hmm.
the unification of how do you propagate price and then how you display price in places where there's regulations about displaying price correctly, clearly and visibly for everybody. Generally speaking, folks aren't super price sensitive to EV charging. Like when they need a charge on a fast charger, they need it pretty desperately most of the time,
Hmm.
or it's like the only option. And second to that is the one exception to that is we tend to see like rideshare drivers being much more price sensitive. They
Hmm.
will shop a lot more for what they need, and it's probably because when you're on a road trip, it's a one-off thing. It's not something you're over optimizing for. But when you're doing it every single day, all the time, then you're probably going to choose the one with the best amenities and the bathroom and the cheaper price. So
Yeah.
yeah,
Yeah, well, and to your point of the road trip, that is a one-off, and probably from an aggregation standpoint, it's probably gonna be cheaper by the time you got from point A to point B in an EV versus
yep.
with fuel. You know, in that whole vein of price per kilowatt, this came up on a previous interview, um, on an unreleased episode as yet, but pricing came up, and we were talking about, and this leads to deploying where it's easiest, deploying where the money's at, but then also that free money concept that helped offset the capital will then
hmm
also, as a probably not the best influencer for progress towards a mature space, but the price per kilowatt. And so,
Mm.
25 cents, 30 cents per kilowatt, you're giving away energy, you're not helping your bottom line. You're not even driving towards an ROI with that. And so we've seen a shift.
And you're
Uh,
setting poor expectations with customers that that's the price, that's the expected price.
Yes, yes, and you don't want to set that expectation. It's
Right.
the free L2 at your site, in 20, 18, 19, 20. That's set a bad precedence for those sites that need to buy and invest and put them in now. Well, you were giving they were giving them away back then. Well, that wasn't the best thing. But anyways, the point being, I digress. Going back to the price per kilowatt, we're seeing areas of the country where the average price is no longer 25, 30 cents, 40 cents. People are reacting to 55, 60 cents. Is that a fair reaction?
I think it is. I mean, you mean reacting negatively?
Negatively, yeah. Like, so
Yeah,
the
yeah.
drivers, why am I paying 60 cents per kilowatt? That
Well,
type of
listen,
thing.
I want to say that when people are dynamically pricing things, they're pricing things both ways, right? Lower
Mhm,
and high, right? So
mhm,
there's times when it's much lower than it would be otherwise that you're also getting as part of dynamic pricing. And if it's not dynamically priced, you're overpaying at certain hours, right? So that's one thing to keep in mind. But I think that reaction that you're seeing is reflective of the fact that in the early days of charging networks,
mhm,
we all felt some obligation to make sure that the cost of an EV, charging an EV was lower than the cost of fueling a car, an equivalent car. And that's very admirable
mhm, mhm.
and it's very reasonable. But to me, that was misread, as in all situations, it should always be
From
cheaper to
here on
charge.
out, yeah.
Yeah, from here on out in all situations. No, I think the main thing that that's saying is that everyone would agree on is, yeah, if you charge it at home every day, it's way, way cheaper, right? And that's what
Mhm,
most people do. They charge it at
mhm,
home.
mhm,
But when you need the 350 kilowatt super fast charger at 5 p.m. on your commute because your battery's busted, I mean,
mhm,
then you still expect to pay less than the price of gas. I don't know. You're paying for convenience, you're paying for speed, you're paying for that service, right?
mhm,
And ideally you would never need it, but it's like
mhm,
a triple top up in that case. So I think that's where the expectations are a little bit incorrect of like, no, these guys have to make money too. If you want the price of the charging to go down, the price of the electricity has to go down. And that's a utility problem, right?
yeah.
Because people are just trying to break even. This is not a case where like, it's like Apple overcharging for the next iPhone. Like they got plenty of money. Why are they being greedy? That kind of thing. Most CPOs are barely breaking even, if that. Most CPOs are not even breaking even. So,
Mhm.
so like you want EV charging to exist, then yeah, you got to think about price.
Yep, that's right. Let them
Mm.
charge the 75%, 75 cents per kilowatt. People are gonna spend it, people need it, they're traveling, they're driving, they're gonna use it anyways. Like you said, the energy's
Yeah,
low.
and if
I
you
gotta keep
don't, if you think it's too expensive, don't charge. Right?
yeah, go somewhere else.
It's just like everyone goes
Yeah,
somewhere else, right? It's
yeah.
just like any other business. It's the same thing.
Yeah.
Give them the signal that it was too expensive.
Yeah, you're absolutely right. It's time to move on as an industry from those mindsets early on that we had to go along to get along. It's time to move on, and we want these CPOs to be profitable because we want to put in more charging stations
Yeah,
because we want higher availability to drive EV adoption. Yeah. So,
exactly.
well, Stable clearly has some great products and great solutions for the CPO and the operators in the space. Stable's also not alone in the EV infrastructure optimization. There's probably utilities that are somewhat of a competitor, I might think, or maybe some
Mm.
other analytic groups, or maybe even OEMs that are all kind of just leaning in. Again, without revealing any of the secret sauce, where's Stable's competitive edge in this landscape of optimization of infrastructure?
We're not super worried about a competitive edge because I think the market is big enough for multiple players.
Mm,
Most of the time, what we're competing with is the customers that own way of doing things that they did it before. Maybe
Mm,
they do this sort of analysis in-house. Maybe they have an operations team who's been doing their pricing. Maybe, and they're considering, should I switch? And, the math works out that, like, obviously my software subscription to you is going to be much cheaper than the team of analysts that you need to run this thing,
mm,
or to build these forecasts. And when you use forecasts out of Stable, you're getting a nice neutral third party opinion. I mean, there's no
mhm,
bias in our. We're not trying to tell you every site's great,
mhm,
right? When you buy a charger, say you're buying a charger from a charger OEM,
mhm.
and you ask them for a forecast of utilization, and they tell you it's going to be good, wouldn't you be skeptical? Because
Yes.
you're buying
Yes.
chargers from them,
Of
right?
course
So
it's gonna be good. It's gonna be great. It's perfect.
yeah,
Yeah. Yeah.
we actually, people use us in addition to their own in-house models,
Mhm.
or if they're raising funding, or if they're acquiring a bunch of charging assets. We're like the third party, neutral, they got no skin in the game, entity to do the thing. And that's it. So point being that the so part of it is that there's like, we have a natural place in the market. Most of our competition is the customers themselves doing it
Mhm.
themselves.
Mhm.
In the case that it's a little bit more direct, I would say our differentiator is more that we're just very dollar focused.
Mhm.
Like, we're not going to give you a score out of 100 and tell you this is good, this is bad. We're going to tell you how many dollars you might make. And in that specific area, in the utility territory, on the specific energy tariff for DC fast commercial charging in the month of March, here's what we expect. And here's an Excel based pro forma that you can export out of our tool that gives you all the dollars and cents worked out. And you can take that forecast and you can discount it and say, I think Stable's being too bullish. I think they're being too bearish. But
Mm.
the point is that I'm getting you to dollars and cents every
Mhm.
time. And so to me, that should be the ultimate decision. It's not just, is this a good site? Of course, there's questions. Is there good capacity? Are there good stores and stuff nearby? There's some qualitative things. We're the
Mm.
quantitative thing. We're trying to get you to, like, the most accurate take on expected utilization and growth in utilization as we possibly can give you, trying to predict the future. And we are
Yeah.
very public about, we publish our accuracy rates to all our customers. They get quarterly updates on our models, and we tell them, here's where we're good, here's where we're not so good, here's where we overpredict, here's where we underpredict. Right? Like, that is available to our enterprise customers
Mm.
who use our software because they're dependent on it to make investment decisions. We're like open book. We're like, here's how it works. Here's our accuracy. You take with it's a grain of salt, right? Take with it a grain of salt, but here's our best possible take on it.
Well, that, I think my first 4 years in this space, I was trying to, like you said, sell chargers. Oh yeah, they're going to be profitable. Here you go, put them in. Everybody's going to use them. It's going to be great.
Mhm.
Wasn't reality. And then, of course, my core demographic that I was going after when I first entered the EV space was the petroleum retail world, and so they had data. They had decades of data on where the gasoline and diesel drivers were and where to build a gas station, all of that. And it was very easy. But whenever it got down to the chargers, you're absolutely right. I was at that time a value added reseller of a couple of brands of hardware, and
Mhm.
they would give me these spreadsheets about, well, the charger's going to do this and it's going to have all these capabilities. And none of the data points was just around, it was all just theoretical around, well, now you have a charger. Well, now someone's going to buy an EV, and they're going to know they've got a place to charge at when they're not charging at home. And it was a mess. It was a mess. And of
Mhm.
course that was, 2016, 2017, 20. I mean, it was early on, but man, this is a game changer. It's a game changer. To me, it's a no-brainer for CPO to not have to try to figure it out. Let data
Okay.
inform on this. Let data define where to go, where to avoid, maybe even where to expand. I'm sure there's some sites that you've been able to encourage to expand
Yeah.
to just keep that utilization. Double click on that utilization and let's take it to the next level. I'm sure there's been
Yeah.
probably examples of that.
What we tell CPOs to do is to focus on what they do best, which is typically like pulling the permit, getting the transform upgrade, developing the site, making sure there's no gas tanks and,
Mm,
easements that are going to screw
mhm,
you later and lose all your money. Like, that's the core competency that is really strong. I mean, a lot of these folks have come from telecom and moved into the space. That's the core competency. Like, focus on the viability, the feasibility, the qualitative things of, like, is there good lighting in here? Is this going to be an approachable place? When it comes to, like, the dollars and cents and the predictive models and the forecasting, there's no point spending all that time in there. Like, this is all we do. All we do is try to predict utilization of DC fast chargers. Like, that's
mhm,
literally all we've been doing for 8 years,
mhm.
or I guess a little bit less now, right? 5 or 6 years straight, just thinking about that. And so, yes, you could probably do it yourself, but is it really worth it? Like, we probably do it for much cheaper for you. And then you do the gut check on top, right?
Right. Right. Well, this has been good conversation. Appreciate all these insights. I'd kind of like to zoom out and look at the industry, kind of at a macro level. And one area of thought that I'm in is market signals. We've
Mhm.
talked about maturation of this industry, and that's kind of been some of this conversation already. What would you say, just as someone that's been in the space, have observed the changes? What's an underappreciated signal that you've seen or that you're watching that tells you that this market is maturing?
I think the clearest one we've seen is because people are using us for diligence. We've gotten a lot of interest in the last, let's say, 6 to 8 months from folks who are looking to acquire assets, EV charging stations that have been installed. Of course, there's less capital available these days, especially in this market
Mhm,
for this kind of thing, and
mhm,
investors are generally bearish on it, right?
mhm,
But if you look at the fundamentals, I mean, utilization rates are the same or better than they were this time last year. And so that means like the assets are still valuable.
mhm,
And so what we're seeing is like large roll ups, PE firms, infrastructure investors move into the space to acquire assets, ideally for cheap, right?
mhm,
Because they know there's money to be made and the market may be overreacting. And that's their bet, right?
mhm,
What's interesting about these groups is that, candidly, they care about the climate and they care about, being green and all that stuff, but they're mainly in it for just to make money, right? They're,
mhm,
they're in it for a return on investment. And that's their mandate of their capital is a return on investment, a specific target they need to hit. So the fact that we're seeing multiple players move into the market, not only domestic players, but also international groups who are looking to expand in the market,
mhm.
United States market right now at a moment of weakness, to me is a really promising sign of the maturity of the market. Like those groups, PE does not roll in when there's no money to be made.
Mhm.
They move in when they think there's money to be made, and it's not valuations aren't overblown, and everybody, there's a way to be cost conscious, there's a way to make a return.
What
So
what
that's
have
really prob
well, that's I appreciate that. What have, in your observations, what have you seen the tolerance levels for ROI with whether it's PE or someone trying to get in the space? What do you feel like you've noticed in terms of commonality as far as the tolerance towards ROI? Are they looking at this? They're trying to flip this in 3 years, 5 years, as a 10-year play. I mean, where are they coming in rational, or are they coming in irrational? Just
Yeah,
at a
they're
macro
kind
level.
of quite rational, especially because they have the benefit of hindsight of like how much utilization did these charges get in the last few years. So
Mm,
what can we expect in terms of growth in the next few years? And what's our payback on that when we for our acquisition price? I mean, they want to flip these ideally as low as possible. It does depend on the capital provider, like what the horizon is, but they won't shy away from an 8 to 10 year horizon. It's just it has to be a big enough dollar amount to deploy against, right? A smaller return is okay if they can deploy 500 million, $1 billion of capital, right?
mm,
But if they get a small return, they can only deploy $1 million. Like, who cares, right? It's not paying, so that's kind of the balance that we have to see. One thing I'll tell you is commonality on these a lot of these acquisitions is they're not necessarily valuing the hardware type, the branding, the app experience. They're just looking at it as there's a plug in the ground. There's this many plugs in the ground and this much capacity for power, and that's it.
mm.
So they're valuing that. They're evaluating it as an asset, a standalone asset, and not the business and the product and stuff around it as much.
Yeah, well, that's good. Appreciate that insight. Looking at the technology side of things, because obviously there's a fast DC charger 6 years ago was, you know, 50 kilowatts, 75 kilowatts, sub 100, definitely kilowatts was a fast charger. And so
Hmm.
maybe some of these legacy sites, the path to acquiring those sites, and there's going to be an immediate need for upgrade to make them relevant in this space where somewhat the baseline of charging is at 150 maybe
Yeah.
kilowatts, even though that may not necessarily be the requirement for that area based on what others around. I mean, again, there's rethinking and retooling the thinking around what is required in terms of output, but that's got to be a factor, and it's got to be a part of the conversation. It
Yeah.
just, I would think, from a future tech standpoint, when when your company is helping your customer look beyond siding, beyond pricing, where does innovation fall into that? Is what's the next innovation maybe in that charging? Is it the hardware? Is it that where are you helping customers think about siding and pricing, but then at a macro level, the site itself?
Yeah, if I think in hardware and stuff, we're actually going to get to like more and more and more commoditized. They'll all roughly look the same, and they'll all roughly be pretty reliable, and that will happen. over time naturally. Now, how long that will take, who knows, right? But it shouldn't, like, we don't even think about the hardware. What gas pump, is it Gilbarco's? Is it, what's the other one?
Wayne.
Something else.
Yeah, Wayne.
Yeah.
Yeah.
Like, we don't, like, nobody knows, nobody cares which pump you're pumping at, right? It doesn't
Mm.
matter. I think it's the same with, it's gonna be the same with charging. We barely care which gas station to fuel at. Do we really care if it's a Shell site or a BP site? No, no. It's like, as long as it's roughly the same price, maybe you care about the amenities. That's it. So I actually think it's gonna be in, I mean, these are internet connected, software defined IoT devices. And to me, most of the innovation is gonna be in how you find and book and reserve and bid for them for different classes of drivers. And so I
Mhm.
think that the charging experience will be, most likely the vehicle is going to automatically find for you, like it already kind of does, right? The most convenient, cheapest charger en route. And there will be sort of a background bidding war happening between computers of vehicles vying for sites and chargers vying for vehicles, offering them different prices, and just sort of trading happening, until they make a reservation, they book it, and they charge there, and the driver just confirms. But maybe you can even incentivize behavior with price. Maybe you can say, for example, that it's a 350 kilowatt charger. Right now, we throttle those charges to manage our energy costs. But you can say, hey, driver, I will offer you the full speed, fully rated speed of this charger, but you got to pay 3x more. So if you're really desperate, yeah, I'll give you this capability. You can charge at full speed right now, but I'm, instead of 30 cents, I'm going to charge you almost a dollar. Your choice. If you're willing to let me throttle you down to like 100 kilowatts or 50 or 75, I'll only charge you 30 cents. So it depends. How long do you want to wait?
Mm.
Right? These are the more like sophisticated, like sorts of behaviors, purchasing behaviors that I think we're going to start, right? We should start seeing in the next few years, that I think people aren't really tapping into well enough. But it exists in every other, similar class of product.
Mhm. Well, Rohan, I appreciate your time today. It's been a good conversation. I think as we get ready to land this plane, just kind of some closing thoughts and parting shots of wisdom. Maybe
Mhm.
you spent a lot of time in the data. If you were suddenly running a charging network tomorrow, maybe this is for a PE that's listening or an emerging CPO that's listening. If you were suddenly running a network tomorrow, what's the first thing you would start doing or stop doing? You can answer that either way you want.
So if I was running one,
If
you're
you
saying
were,
with charges already
yeah,
existed, or like,
yeah,
or
yeah,
starting from scratch?
you're a CPO tomorrow. You've
Yeah.
seen the data, you spent time in the data, so you know where to go, where not to go, and way to think about which way
Yep.
that's pointed. Or maybe you answer it this way: what does CPOs need to stop doing or start doing
Yeah.
today, or doubling down on?
Can the sites that aren't going to make it, that they're just never going to hit that utilization potential,
Shut them down. So what
shut
you're
them
saying,
down,
shut them
sell
down.
them
Okay.
off, shut them down. Can them? They're a drag, brand harm that they will cause to you for being broken all the time, or they're underutilized from a cost perspective, or you're rolling trucks all the time. Just got to can them. Like, you got to rip the Band-Aid, focus on the ones that are good, and recapitalize with liquidate them, recapitalize, and then reinvest again. And don't be caught in this game of like, you're trying to grow this metric of number of ports installed at any cost. Be willing to drop that metric of number of ports installed, so that the number you should really be looking at is ROI.
I imagine you've had to say that to an operator, and they've probably not wanted to hear that. They've probably been attached to the whole sunken cost theory, and it's just double
Yep.
down. No, let's wait and see. And yeah, so I imagine that's a conversation you've had because you've had data to support that.
Yeah, I just got. I mean, it's just business, right? And we
Mm.
have to treat it like that. If you own a chain of restaurants of like Chili's locations, then there's a Chili's locations that's not turning a profit. How long are you going to wait for more people to come to that Chili's before you sell it to somebody else and turn it into a Chick-fil-A, right? Like,
Yeah,
that's
yeah,
the question.
yeah, yeah. Good comments.
Yeah.
Good feedback. And agreed. Well, Rohan, thank you for being on Field Frequency. For those that want to connect with you directly, want to learn more about Stable, learn about what you're doing in the space, reach out to you. How do they connect with you?
Yeah, just reach out direct. LinkedIn is the best way to reach out to me. I'm very responsive on LinkedIn. I post all the time. And I, hear a lot of people that way. So please reach out to me on LinkedIn. That's the best way to reach out.
Great. Thank you for
Cool.
being on Field Frequency.
Thank you, Jason. Appreciate it.